Hello, guys, and once again, welcome to my channel, Economist Unplugged with Praful Raj. My channel is about the insightful conversation with economists, professors about the Indian economy. Today, our special guest is Debopam Chaudhuri. He is a chief economist at Piramal Enterprises. He is associated with the Reserve Bank of India's panel for professional forecasters, Reserve Bank of India's systematic risk panel, and he played key role in advocating policy reforms to aid NBFC industry post ILNFS and COVID-19 to Prime Minister Office, Ministry of Finance, and Reserve Bank of India. He is an active stakeholder in India's startup revolution, having incubated Zinfin and being a co-team member in another company called TrueBoard. I welcome you, sir, and thank you for taking time to join me in this conversation. I welcome you, sir. Thank you so much for coming to my channel and agreed for joining for this insightful conversation. Today we'll talk about NBFC. It's a non-banking financial corporation. So basically NBFC plays a very important and integral part in the Indian economic growth in the financial system. So now the question is how it is different from bank. So basically the one of the basic difference between the NBFC and bank is that NBFC cannot accept demand deposit. There are many other, of course, in terms of regulation, everything, there are differences, but this is one of the basic differences. Now, we will get to know more about NBFC in our talk from sir. So, sir, welcome back welcome to channel once again. And here I'll start with the first question. So, like we all know that, with the bank, NBFC plays a very important role because it lend money to all kinds of businesses, all different kind of loans. So what do you think, like what is one few things that NBFC does, which bank does not, does, and it's not, maybe not successful in doing that. So what are the few unique things that you think?
Right. So when you say NBFCs or shadow bank in the US, that's what they're known as, it's a little complicated than a normal scheduled commercial bank, the way they operate. Okay. Now, for a bank, if I have to classify them, a bank would be a generalist, while NBFC would be a specialist. That is because NBFC, the umbrella is NBFC, but within that, there are various nuanced institutions which exist. So in India, there are more than 9,000 NBFCs. So you can imagine the scale, right? And each one of these NBFCs are tackling a particular problem, unlike a bank. So if you go to a bank, you'll get a home loan, you'll get a car loan, you'll get a gold loan, and all sorts of services that are under you can imagine of is available, which is not the case with NBFCs. So the major categories of NBFCs would be, say, infrastructure finance company. Infrastructure finance and company or NBFCs are the ones which only finance infrastructure. They are into long-term loans, they are into big ticket loans, and they are only focusing on, say, constructing a road, constructing a power project, constructing a bridge. If you want finance, they are the guys to go to. Then you'll have, NBFCs which specializes in commercial vehicle finance. So if you want to buy, if you're a transport operator, you want a truck, there's a specific NBFC out there who can help you out.
Yes.
Similarly, there is an NBFC which is a gold NBFC, right? Now, the gold NBFC specializes in gold loans. So, and then finally, we have housing finance companies. That is also a type of NBFC which only finances homes. So, if you want to buy a home or if you want to construct a home, these are the guys you want to go to. So, it's a very complicated universe. For simplicity's sake and for the sake of better regulation, we term it as NBFC as a single brand. But yeah, so the contribution comes from various angles, and this is where they make a huge difference to the economy. So unlike what a bank does, the specialization that NBFCs offer helps them to make loans very quickly and reach out to people, and most of these customers were previously unbanked. So the financial inclusion component of any economy is further catered to or further supported by what you know as NBFCs, unlike that of banks.
Okay, so thank you for the clarity, like what exactly other NBFC does apart from banking. So you are a chief economist in Piramal Enterprises, the NBFC arm of Piramal whole as a conglomerate. So what exactly, on what sector Piramal just contribute to the economy? What are the, like, does they do all kind of loan or a very specific?
So Piramal is registered with the Reserve Bank of India as a housing finance company. So as I said, housing finance company is a different type of NBFC which only specializes in loans. So that's what, the majority of the business of Piramal is catered to. So they are into providing housing finance as well as developer loans to a developer who wants to construct an apartment building or a hotel or so on and so forth. So that's the space Piramal works in. So
Yeah.
that's where we specialize. Yeah.
So just so as we know that bank also gives the housing loan. So if you can put out what makes Piramal NBFC like more efficient because it's a housing finance only, like in terms of the time, in terms of the process, like.
So since the job is a little simpler because, as I said, NBFCs are specifically focusing in only one area, unlike a bank. In our case, in Piramal's case, it is housing finance. So the way the team is staffed up are all experts in the housing finance space or the real estate space. So
Yeah.
they understand. So we have very good quality people, very good quality analysts who understand the Indian real estate sector really well. So because of this, characteristic, underwriting at a company like Piramal, who's specializing in a certain area, becomes quicker and much more robust. So we can turn around quickly compared to some large bank which is also looking into 20 other things, and housing finance is just one of them. So that's where the difference comes in, and we can also reach out to more riskier cohorts of the public, of the customer base, because we understand the sector well. And similarly, say for infrastructure finance NBFC, they can reach out to more riskier infrastructure because they understand the infrastructure place well. So that's where a company like Piramal can create a major difference compared to how a bank would operate in the same space versus a specialized NBFC would be operating in the same space.
Okay, so basically it's just that the unique part is that every bank, every NBFC has some specialization. So it helps them to deal it in a better way. And maybe this is one of the reason that the non-performing assets in the NBFC is low as compared to bank, because every NBFC has a expertise in understanding that sector. So with all that, but anyways, RBI always plays important role. They have always a control over the NBFC from the as a part of an act. So my second question in that RBI is taking a different kind of measure in last few years. So to prevent the crisis what we happened to ILFNS and the Diwan Housing Finance. So what are the recent policies that has been implemented, and do you think that RBI is going basically restrictor in terms of regulation and kind of hindrance a long term NBFC as a beneficial of other economy and all?
Okay, so if I understand the question properly, you are wanting to know what are the recent regulatory changes that has come into, the
And
regulatory space, right? Yeah. So first of all, like every industry, when it becomes critical in shape, when its interdependencies with the rest of the economy becomes more important and more deeper, there is a rise in regulatory for regulatory foresight for these industries, and that's exactly what has been happening in NBFCs. Now, with time, as banks have been moving out from lending long term for infrastructure or some of these riskier customer cohorts, etc., consumers or NBFCs have been taking up this place, have been replaced. When banks are exiting a certain place, a vacuum is created and NBFCs are entering this vacuum.
Right.
So as this process went on, the relevance of NBFCs also went up very significantly. And since NBFCs are not typically your bank wherein you get deposits from regular people like you and me, and then the same deposits are extended as loans, NBFCs raise the funds from, by borrowing from other institutions like a bank or a mutual fund or some other pension fund, etc. The responsibility for an NBFC to ensure that the loans are being disbursed in a proper way, the monitoring of the loans are being done properly, becomes much more important. So that is the reason why RBI, given the increasing importance of NBFC, has become much more proactive now than it was perhaps 5 years back in time, and wants the NBFCs to operate at the same level of expertise and regulatory adherence like the banks. And hence, a lot of these new regulatory, changes are happening like the way you mentioned. So one of the most important changes to have happened in the last 2 to 3 years is the scale-based regulatory framework, wherein RBI has defined thresholds to bucket NBFCs into 3 or 4 categories, depending on the size of the loan book and the scale of operation of the NBFCs. And of course, it's quite intuitive to realize that the NBFCs which are in the top 2 buckets are much more regulatorily exposed than the ones which are in the lower buckets. The lower buckets NBFCs are the smaller MFI type of organizations, which may not be able to afford those amount of implement those regulations compared to someone which is in a band A or band B. So this scale-based regulation, on one hand, is highly focused on the much bigger NBFCs, which are a bigger risk to the economy, while at the same time it is giving the required, flexibility to the smaller ones to at least initially grow in scale, and then once they grow, they can obviously belong to a group, band 1, band 2, and then face significant regulation. Now, that's not the case with banks. The moment you are a bank and get a bank license, no matter what is your size, you face, so SBI, whatever regulations SBI faces, the same amount of regulation, say a small bank like a Catholic Syrian bank will also face, right? So
Yes.
that's the major difference between how RBI looks at NBFCs and how RBI looks at banks from a regulatory standpoint. But yes, the regulations are tightening, and which is a good thing. And it also shows that this industry is becoming more and more important by the day, and hence more and more regulations are coming into this industry.
Okay, yeah, got. So basically, since the economy is more dependent on NBFC, so it is RBI don't want to get it collapse in one, so it's like tightening the regulation. So it contributes also, and as well it's under monitored.
Yeah,
So
so if you may remember something from the global financial crisis of 2008, when this term got coined, which was too big to fail.
too big to fail, correct? Yeah.
So such too big to fail NBFCs are now existing in India, okay? And it
Yeah.
becomes very important for these too big to fail institutions to stay secure, to stay safe, and to stay strong. Because if they collapse, in fact, DHFL and ILFS were one of those
Yes.
too big to fail institutions. And because they collapsed, initially no one expected them to collapse, but because they collapsed, RBI became much more proactive to safeguard the other too big to fail institutions which are out there. Because if they fail, the impact on the economy is going to be much more severe than maybe the smaller NBFCs, which are in the lower category or the lower bands, as I said, of the scale-based regulatory framework.
Yeah, I mean, as per the October 2022 reports, the total asset is around 42 lakh crores. So, of course, it's a significant amount. If something goes wrong, considering a low income country, it will impact much more and much more significantly compared to other economies. So, coming back to the third question, sir. So, we know like every NBFC is trying to helps in lending. So what about now here the question comes is that if you talk about the urban area, there are already banks, there are NBFC. It's easy to reach out to urban customers than a rural customer. So since there are approximately 9,500 NBFC registered with RBI as of October 2022 figures. So in terms of like how like NBFC currently now reaching to rural area, and the area which is not less covered, is it covering, the coverage is much significant for those area in India, or it just tier 1 cities, tier 2 cities?
See, from a business perspective, it also makes sense for NBFCs to expand in non-metros, especially tier 2 and below type of cities and towns, and even rural centers. Because as you rightly said, the metros and the tier 1 cities are well supplied by these larger banks and some of the larger NBFCs. So there is not much scope for expansion. People there won't be, taking a loan at a 12% or a 13% at which NBFCs typically tend to operate. So it is in the interest of NBFCs to branch out to the smaller centers of the country, and it serves the dual purpose. So it is good for NBFC as a business, and also it's good for the country's economy, because then that promotes or encourages financial inclusion. So banks and larger NBFCs are may be a little hesitant to expand to smaller towns because they have a lot of business in the larger cities. But then that gap is being filled by the other NBFCs who doesn't get a lot of business in the larger cities, but they'll get a lot of business in the smaller cities and smaller towns. So it's kind of a self-fulfilling kind of a relationship between the size of the location and the expansion of business that NBFC can garner. And hence that's where the new NBFCs are expanding. So if you look at all these fintech NBFCs, all the recent NBFCs which have come up, as well as some of the traditional NBFCs which are already there but are not as big as, say, a HDFC,
Yes.
you will find them opening up shops and opening up branches a lot more in the tier 2 towns than their presence is felt in a city like a Mumbai or a Chennai or a Kolkata or a Delhi. So that's exactly what is happening, as we speak, and that makes business sense. That makes economic sense. It serves both the world.
Yeah, but there is a huge opportunity still lies which new NBFCs are tapping. But what about the bigger NBFC like Piramal, HDFC, Shriram? Like, are they also going to that small metros? I know the cost will be high because of regulation. So, are they also planning or like trying to go to reach out to those people also, or just
Yeah,
this?
absolutely. No, absolutely. So even the bigger NBFCs, even HDFC, you will find HDFC branches in the smaller towns. As far as we are concerned, it is one of our mandate, and it's pretty much explained and in the public domain, it is available that our focus area for retail loans would be the smaller consumers in smaller towns, right? So it's not the metro customer that we are after. Even say a Sriram Transport, which specializes in commercial vehicles, their second-hand truck financing business is mostly catering to smaller towns where the second-hand truck operators and purchasers exist, right? So NBFCs by definition will be successful only if they branch out in the smaller towns, because the bigger towns and bigger city business is already being catered to by the larger banks, as I said. But you're right, even someone like a Piramal or a Shriram or HDFC, they have a significant presence in tier 2 towns. Now, if you talk about villages, maybe village presence is not as much, because even now India is considered to be a data dark country, where we don't have a lot of data about the credit history of customers, especially beyond a certain size of city. So the moment you are out of tier 3 cities or towns, the availability of data becomes a little bit of an issue, right? And unless we get the data, there is no way we can underwrite a person who's applying for a loan.
Yes.
But then with data analytics, a lot of artificial intelligence engines coming on board, with fintechs applying or integrating these into their business models, the data problem is gradually getting resolved. Even at Piramal, we have a huge data analytics platform and a team which is working to address this issue, so that we are collecting data from lesser known customers with very little credit history, so that at the end of the day we can assess them, we can assess their credit profile with whatever data we can collect, and at the end of the day we can give them a loan that they require for the business expansion or their household improvement or whatever the need may be. The data collection process is something that is undergoing, and with the new modern technologies, this is a problem which can soon be overcome.
Yeah, I mean, you rightly pointed about this credit score. Actually, in India, tier 2 cities and villages does not have a credit score of an individual person. So it's very difficult to give any kind of loan. I mean, any kind of loan. So I think, yeah, this is the biggest problem, especially in a rural area. So as there is a very popular opinion about NBFC that people also don't reach because of the higher interest rate, very high interest compared to bank or any traditional banking. So as per in FY23, the NBFC average borrowing cost is approximately 7.2 to 7.4%, and this also increased by 100 basis points after COVID. Before COVID, it was 6.5 or 7. So even after this, the cost is low. Why the NBFC gives loan from 14% to 22, and sometimes even 28 and 30%? Like, what's the reason behind it? Considering the cost will be like 2 or 3%, like what exactly is that the reason behind that?
So credit quality. So when you say NBFC average borrowing cost was 7.5%, as I said, NBFC is a very diverse universe. Okay. If I have to look at initially to your first question, I explained NBFCs and by the various types of businesses they are doing. It's an infrastructure NBFC, it's a housing finance NBFC, it's a gold loan NBFC, etc. Now let me tackle this question with the credit quality of the NBFCs. So there are a bunch of NBFCs which are rated AAA. So a HDFC or a Bajaj Finance or this Aditya Birla Finance, Tata Capital, they would all classify into the highest rated universe, which is AAA, which means an institution
Yes.
like a Crystal
Yeah.
or a Moody's have assigned that rating to them. Then there's this second bunch of institutions which are rated the double A. And then there is A, and it goes so on and so forth. So the 9,000 NBFCs that we just spoke of are present across this rating spectrum. The interest rates at which NBFCs borrow differ significantly basis which rating basket you are in. Okay, so if you are a AAA, you can raise funds which is at a rate which is not more than say 50 or 75 basis point than what the 10-year government security is going at. So right now, 10-year government security is 7.2%. So someone like a HDFC can borrow fund at say around 7.7% or at the most 7.75%. However, the risk premium keeps on increasing as you move down the rating spectrum. So AAA, I just told you about the example of HDFC, how it will be 50 basis point over and above what the 10-year GSEC is. Let's come to AA. Now in AA, since AA means that these NBFCs these are good NBFCs, but they're slightly more riskier than the AAAs. So an investor who's investing or who's lending money to a double NBFC will say, boss, if I have to give money to you, vis-a-vis a HDFC is more secure. So my money is more secure there. Yes. But if I have to give you money, you will have to pay me an additional interest rate to take care of the additional risk that I'm taking by investing in a AA issuance rather than a AAA issuance. So then that interest rate becomes a little higher for AA rated instruments. So while I said for AAA, it is 50 basis points higher than 10-year GSEC. For a AA, it can be as high as 100 basis points.
100 basis point, correct. Yeah.
So say if the GSEC is at 7.2, the AA guy will get it at 8.2. So the additional 50 basis point rate that happened between a AAA and a AA is the risk premium which investors associated with a lower risk institution. Similarly, when you move further down to AA, it becomes 150 to 200 basis points higher than the GSEC.
Understood.
So it's not true that if you look at the average interest rate, you get a sense of what is the rate of interest at which NBFCs are borrowing. The borrowing cost is very different depending on what rating category that NBFC is in. So that's one end of the problem. The other end of the problem is when giving out the loan, NBFCs, as you rightly said, the plan of NBFCs is not to expand businesses in metros where you find safe customers. A salaried person, a doctor, a CA, an engineer, these guys would be more prevalent in a metro. They are safe guys. You can give them loans at a lower interest rate. But then if you are giving a loan to a self-employed person who's running a fabrications business, say metal fabrication business based out in a tier 2 city, the risk associated with that guy to default versus a salaried guy working, say, at a Tata Sons or wherever in a metro, the self-employed guy's risk in a smaller town is way higher.
Very high.
So someone has to compensate for that additional risk, right? Otherwise, what's the point of NBFCs taking so much trouble and giving money to that risky individual? So the way the NBFC would assign a rupee value to that higher risk is by charging a higher interest rate to the risky person. So just like how an investor investing in NBFC will charge a higher premium while investing in a AA rated NBFC or a A-rated NBFC, similarly, when an NBFC is giving money, they will charge a higher rate of interest to the more riskier individual or the more riskier business. And hence, that is the reason, when the NBFC is lending, the rate of interest typically ranges anywhere between 14 to 20% as we speak today. So that's the risk premium which we're talking about. Tomorrow, if this risky individual defaults, then we need to have a higher interest EMI for that guy till the time he was defaulting to take care of the fact that he has defaulted and there'll be no more money coming from him going further in future. So you have to monetize that fact, right? So, and hence higher interest rates are necessary. Otherwise, there's no point for NBFCs to exist.
Yeah, I mean, NBFC has to bring a balance between words. So in short, basically what you are saying that the very first, the basic thing is that the GSEC has to go down to get, I mean, the moment, and GSEC will only go down when the whole overall economy will grow, the interest rate will come out. So it's the circle that has been created. And second, yes, NBFC, since it doesn't take any deposit, then NBFC has to save itself from the riskier assets. Okay, so that's why, and you rightly mentioned that yes, it also depends the type of NBFC. Of course, HDFC and Tata will give it a lower interest compared to double A rated or probably triple B rated NBFC. Okay. So in that sense, like, can you tell us what are the significant challenges that is being faced by NBFC and how it is addressed by the relevant stakeholders? Like, my question is that, like, government knows that NBFC faces these kind of challenges. How much government supporting NBFC maybe in creating kind of infrastructure, like, what are the problems and how it is being addressed by different stakeholders?
So challenges, the only challenge that an NBFC would ever face is its access to liquidity or access to funds. So like I said, unlike a bank, NBFCs, most of the NBFCs, there are some NBFCs who can take deposits, but majority of the NBFCs cannot take deposits. So that is a big challenge for NBFCs when it comes to raising funds, because those are the same funds which the NBFC can then use to give us loans, right? So that's the major challenge. In India, being a capital-starved country, access to capital most of the times is very difficult and happens at a high cost. So this is something that everyone, both the RBI as well as the government, has been working on to ensure that the flow of funds to NBFCs is reasonably decent. Okay. So, and for that to be reasonably decent, what is most important is the risk sentiment regarding NBFCs, how the market perceives NBFCs to be, how risky are NBFCs, that needs to go down. The moment market sees that, okay, NBFCs are strong, NBFC balance sheets have no problems, then automatically the markets will start providing further more funds to these NBFCs. How will you do that? You can do that through, regulations. And that's what RBI is doing. That's what your second question was. The third question was. So when there are tight regulations, investors in the market will realize, okay, now NBFCs are adhering to these regulations. Say, for example, every NBFC now has this liquidity restriction of, they have to maintain liquid funds for which is equivalent to 100% of the short-term obligations or short-term liabilities. So no NBFC, there's no major risk of an NBFC to default, at least in the shorter term, because the LCR regulations are being met. So this is just one example. So that instills a lot of confidence into the market. So similarly, other regulations like the scale-based regulations are ensuring that the large NBFCs, there is very little risk associated with those NBFCs today because RBI has taken care of the regulatory aspects. So then the confidence amongst the larger NBFCs becomes high and they start getting a lot more money than they used to. So I'll give you an example. In the latest financial stability report, which RBI keeps on publishing twice a year, they analyze the impact that a failure of NBFCs can have on a bank. Okay, now banks are the biggest lender to NBFCs.
Yes.
So if you look at the NBFC fundraising pie chart, you will see bank borrowings occupy the highest percentage share, followed by mutual funds and foreign borrowings and so on and so forth. But they are very small. More than 40 to 50% of the funds that NBFC has is coming from banks. So RBI does this exercise wherein they figure out if the top 5 NBFCs were to fail together, if there is a contagion like it was during GFC, if the top 5 NBFCs were to fail, how many banks will also fail? Because if the borrower fails, then obviously there will be an impact on the lender, right? The lender won't get the money back, and the CR ratios will all get jumbled up. So just after IL&FS, if you look at the reports which came out from RBI, the FSR reports, you will see that if top 5 NBFCs failed back then, there was a high risk of 3 banks failing, right? So that was the relevance of NBFCs back then. Now, because of increased regulation and improving balance sheets of NBFCs, even if top 5 NBFCs fail, there'll be no significant impact on banks. Because the way that NBFCs have been acknowledging keeping provisions and all of it because of higher regulation, etc., their risk on the banking system has gone down very significantly. So this is a very positive change in the environment, and it will give a lot of confidence to whoever is lending money to NBFCs. So government has done a lot, especially after IL&FS and COVID, to ensure that the confidence in NBFC remains very, very high.
Yeah, so basically confidence and sentiment, and of course the regulations is like something goes wrong for the short term pay. NBFC itself can cover from its reserves, like what happened to SVB Bank. They were not able to cover it because they don't have a liquidity because of all invested. So that's good. That's, I would say, a good regulation, which is not actually becoming hindrance for NBFC, but creating a more confidence, and for an investor will maybe more invest with a less interest rate. So coming back to our last question, sir. So do you believe that, or do you think that there are more potential growth for larger NBFC to come in the new and in the market, and microfinance kind of NBFC can still enter in the market and can have a good share of a market?
Yes, yes. So as I said, India is a capital-starved economy. Okay, capital is deficient here. We have a lot of labor because of our population, demographic dividend, and all that. But when it comes to capital, there is very less of it. So any business model which is catered towards providing capital in the economy will always be a success. And NBFCs is one such business model which, over and above banks, promises to provide additional capital in the system. So growth of NBFCs is something which no one can stop. It's definitely going to happen. However, the smaller NBFCs, the risk that are associated with them, and the operational challenges that they keep on facing, including lapses in terms of due to a lot of corruption and all of it, maybe there's going to be, actually it's already in place, a lot of consolidation is expected in this space. So the larger NBFCs will gradually become larger. There'll be a lot of mergers and acquisitions which you'll see in this space, and there'll be only maybe 15 to 20 large NBFCs which will survive, and they will do a lot of good work compared to the 9,000 NBFC space that we see right now. So this is what is going to happen, but the large NBFCs will become larger, and they're going to serve a much more important role than they are doing today. Yeah.
Yeah, I mean, this is normal trend in any sector. Like when it start, every small player comes into the picture, and then when it start growing, we need more capital. And of course, the bigger player has a more capital, and to survive, it's about survival in the market. So ultimately, it will be acquiring, and few, as you rightly said, depending on the market situation, few will be left to serve the greater purpose of the country. So
Yeah.
I think this topic is very intriguing, and we can keep going on this topic. So here we'll stop. Maybe some other time we'll have a more discussion on this NBFC. So thank you so much, sir, for coming to my channel and discussing about NBFC. I hope our audience will be much more well informed and might go to Piramal Enterprises for housing interest and all. So thank you so much once again, sir.